The other very, very important concept to understand when we talk about leverage and margin is this concept known as exposure. So in the example that we just gave, once again, 100 ounces of gold times 1,200, let's call it, per ounce equals $120,000 worth of exposure. So now, even though our account balance is in this example here, once again, is only 10,000 or thereabouts, we have an exposure of $120,000 to the price of gold. So we're gonna make or lose money based on that full exposure to that value there. So that's really important to understand. Our account balance is 10,000 once again. Which means in this case we've got actually got 12 times exposure. Okay. So this actual total exposure amount is the real leverage that people need to focus upon. People get caught up in this idea of margin rates and leverage rates. The real leverage to keep under consideration is the size of your exposure, the size of the total value of trades that you have out there in the market, whether that's one trade, two trades, or 100 currently open trades, the total value of them relative to the size of your account. That's actually your leveraged exposure to the market. Really, really important. Got that?
Yep, Adam. Yeah.
Really? Sure about
that? Yeah.
All right. Take your word for it. So now we have this calculator there on the website. What we're going to do is we're going to turn a lot of these pages into courses. Okay. So this is the leverage calculator here, and it's actually you can term it as relative leverage or leveraged exposure, but it's part of an essential risk concept. Now, so once again, we've got our account balance there, 10,000. Now, as a trader, you should not be overly concerned over whether or not you're getting trades at 1% margin or 5% margin or whatever the case may be. Because unless you're a very aggressive trader, a very aggressive short-term trader and a higher level risk taker, even 10 to 1 should be plenty for you. Right? 10 to 1 leverage is 10% margin. Right? So people, this is going to come up during the account opening process, by the way, because when the client's got to open up an account with Axie, they're going to be asked what kind of leverage they want. So you can tell them to choose the 200 to 1 or the 100 to 1. It doesn't actually matter because we don't even use a small amount of the total leverage that's available to us. So when you actually put together your trading and investment plan as part of your goal setting process, what you want to be doing is you want to be looking at is not worried about the leverage, but you should be setting yourself a maximum exposure ratio. So here we have in this default here we have a maximum exposure ratio of 3:1. So that's why the green bit here is 3 times the size of the blue bit. So if you were a little bit more aggressive, you might say it's 5:1. 5:1 is still pretty conservative. Hold on. Your best units out of speaker. Yeah, can you call me back in about 30 minutes, please? Yes. All right, thank you. That was Zoho, by the way, they just called.
Yeah, cool.
So 5:1 maximum exposure is still pretty conservative. What that means is that you now have a total leveraged value of 50,000 that you can then go out there and allocate to the markets. You might put some in FX, you might put some in US stocks, some might be long, some might be short. You know, it doesn't really matter at this point, but that's the point there is because you've set yourself a maximum exposure ratio of 5:1, you've now got 50,000 to go out there and play with. Okay, so for the sake of this example, we'll leave that at 10,000, but we'll set this at 10:1. Okay, so you now have 100,000 to go out there and play with. And so say you go out there and you take $50,000 worth of trades in various things. So you now have your open trade values relative to the limit that you set yourself, and it's still within your range there. This calculator, however, will tell you, or indicate to you if you've gone over it. Okay, so now your open trades value exceeds your maximum exposure. So brokerage setting, your broker value very aggressively and very, very high risk relative to the amount that you should actually be trading if you're being sensible. But through this education process, we don't just want people to understand the basic concepts, but we want people to we want to set people on the path to trading sensibly and reliability, because we want people to survive for the longer term rather than destroy themselves in the first 3 weeks, which believe me does happen. Okay, so you go out there now and you've got $100,000 worth of trades, and you're now at the limits of your maximum exposure. This could be $1,000 trades, it could be $52,000 trades, it could be one $30,000 trade, another $30,000 trade, and 6 $10,000 trades. It doesn't matter, but it's the total value of your currently open trades. And this, of course, generally, as if you're buying and selling, it's going to sort of oscillate and sort of go around these sort of levels here. But we're putting that back to 100,000 for the time being. Here's the point when it comes to margin. If your account is set at 10:1 leverage, that little amount there is going to be the approximate, is going to be your margin required. If your account is set to 50:1, your margin required is much less, but that has no effect on the value of your open trades. So people have this misunderstanding about the importance of leverage and the importance of margin. They should not be focused on it. They should be focused on exposure, what the maximum value of their trades is relative to the size of their account. right?
Yeah, yeah. I can now understand how to use the leverage calculator. I've been thinking about that uh, last time.
Sure, sure. All right, well, that's probably enough for today. Um, there's a few little bits and pieces there that can be turned into articles and shorter videos and so on and so on. So what we want to do now is we want to get this uploaded to YouTube, and we want to then yourself and Victor, yourselves and Victor want to collaborate upon this to talk about which sections are going to be used for what. And then you guys are going to turn it into a little PowerPoint and a little article on a page. And then I'm going to produce a more polished video that's actually, properly professional and, not very informal like these ones. And then we'll publish it and we'll send it out to people. That's the general process.
Okay. Yeah.
All right.
Gotcha.
Any questions? Ace, Arvin, there's been 0 questions from you. What's going on?
We're just listening to your lesson.
Hey?
Yeah, about the leverage and
What is it?
Speak up, man.
You guys, eh? Hello?
I'll also be showing Arvin the presentation or the lesson yesterday, so he can follow up with some of the terms that we have used today.
Yeah. Well, what about right now? What about questions right now?
Yeah. Go ahead and ask, man.
Go ahead, man.
Both of you.
Um,
Questions? Some questions.
Questions.
Well, after these guys. Come on, Arvin. You're on the spot, mate. This is your time to shine.
yeah. Well, until now, still a bit confusing about this trading things because this is the first time that I've heard about this. But they keep on explaining me these things. So I'm wondering, do we really use liquidity for the customer? This is the thing that we usually use.
What's that?
Is liquidity the best trading that we are using here?
Well, we do.
I'm sorry. CFDs. I'm sorry. Because
Well,
CFD is just I'm sorry. Leverage liquidity is just a part of CFDs, right? So
Well, liquidity is a part of any market. Anytime you're buying and selling, the liquidity is just a measure of how many buyers and sellers there are and the quantities that they're buying and selling at. So, for example, if we were to go to okay, so now if we look at what do we go? Okay, so let's have a look at Facebook.
sorry.
move nicely. So this is Apple. Okay, so this up here is the price of Apple. These bars down below are the volume that was bought or sold on any particular day.
Okay.
Right?
Okay.
So on this particular day here, doesn't give the exact value. So on this particular day here, you can see there was, probably around 3 times the amount that was sold on this day. Right?
Yeah. I can see that.
So you can see Apple there has an average volume of 24,384, 24,196,384. So you times 24,196,384 times $207 per share. That's a lot of money that's transacting on a daily basis. You know what I mean?
Yeah. It's like 408 euros for it.
Average volume, that's the number of trades happening in a day.
It's not the number of trades, it's the number of shares traded, the number of stocks traded. So this could be done by 1 person or 3 people or 1 million people, but it's a total of 24,000 trades at around $200 per share. Okay, so
Yes.
okay. So about $5 million worth per day. That even sounds a bit low, doesn't it? Okay. Okay, and then we look at, so let's look at, say, Facebook, for example. So Facebook is trading
22,000.
Let's do 24, hold on a second. So 24 million, sorry.
24 million.
Yeah, 24 million, that is, should be. So that's $5 billion worth per day, isn't it?
Mm-hmm.
So okay, so it's about $5 billion worth per day. So it's trading, not 5 million. That did seem a little bit low. And if we compare that to, let's say, Twitter. So Twitter is also a very big company, and it's obviously fairly closely related to Apple in the sense that it's a tech stock at least. But here we have 30 million. times 3282. So we're looking at a bit under $1 billion there. So, so what that means is that compared to Apple, it's about 1/5, or Apple is about 5 times more liquid than Twitter.
Oh, yeah.
Make sense?
Yeah.
So Twitter's doing an average volume of about 1 billion, and Apple's doing an average volume of about 5 billion. That means if you're going in and you're trying to buy, say, $500 million worth at a time, you're going to be able to do that more. You're going to be able to do that more efficiently and more easily and more reliably than you with Apple than you are with Twitter.
Yeah.
But these are both very big companies, of course. So you've got to understand that if you're trading a smaller company, then that's when liquidity comes into play much more. Like if you're trading some of these Australian companies, for example, especially the smaller ones, even if you're going in there to buy, say, $50,000 or $100,000 worth, you can start to encounter liquidity problems if you're not trading big markets.
Okay.
All right.
All right.
And if you So now we look at something like the euro versus USD, and we've got, we can see there, this is the euro dollar versus the US dollar. We can see that's about 60 times, sorry, about 107.5 times bigger than Apple.
Yeah.
Right?
Yep.
So that's why we say that the FX is the most liquid market.
Oh,
Yeah. Next question.
Next question, guys.
What are your questions, Victor?
Question. Well, basically, you answered my question earlier when you discussed about the liquidity part. Because I was wondering earlier why, well, although I asked this question before, why is Forex and gold more liquid than shares? But I actually figured out the answer when you were explaining about Apple and Twitter.
Okay.
What else? So is it like, for example, if the leverage is high, so and of course the margin rate is like the amount of money that you put out in simple terms, right?
Mm-hmm.
And then the broker is basically the one like covering for the rest of the amount.
Yep.
So if there's high leverage, does that also mean that the cost, or I mean, the finance fees of the broker is higher